While retail traders wait for a return to $1, the XRP ledger has expanded to 8.18 million active addresses. This record network participation suggests the $1.42 level is now functioning as the base for institutional accumulation. Reaching this level required absorbing a 61% crash, which recently dragged the market through a 38-day stretch of extreme fear, the longest period of sustained anxiety since the Terra Luna collapse. That fear cycle ended when the artificial intelligence token sector saw a sudden 12% surge in aggregate valuation. This triggered a capital rotation. Large-scale investors are shifting those profits out of volatile AI tokens and into high-utility infrastructure networks like XRP to preserve gains. This momentum is the result of deliberate institutional positioning. Large-scale capital is moving back into foundational assets for the next phase of the market. Even with this capital rotating in and network usage at all-time highs, the price remains compressed in the $1.40 range. The scale of the network growth is evident in the expansion of automated market maker pools. These decentralized liquidity contracts on the ledger have grown to nearly 28,000 active pools. The stagnant price on the charts is currently decoupled from the buildup of the network's underlying architecture, hiding the energy accumulating within the system. This energy is currently being suppressed by a heavily defended resistance level, sitting exactly at $1.45. This chart plots XRP supply against last purchased price. 36.8 billion tokens, 60% of circulating supply, are held at a loss. This disposition effect means as price approaches 145, underwater investors sell to break even, creating a massive sell-side wall. This psychological pressure appears on the charts as bearish pen bar rejections. These long upper wicks at the 145 boundary show that every attempt to move higher is being met with immediate selling. $1.45 is a literal wall built out of retail exhaustion and trapped capital. While retail traders are selling to exit, institutions are taking the opposite side of the trade. Whale wallets, large holders of at least 100,000 tokens, are currently accumulating over 11 million XRP tokens every single day. Simultaneously, spot ETFs have absorbed over $1.25 billion in capital inflows, completely removing that supply from the open market. Real-world utility is adding further demand, with Rakuten integrating XRP payments for its 44 million Japanese users. These forces, whale accumulation, ETF inflows, and payment integration, are acting as a mechanical battering ram. They are systematically absorbing the retail sell-side liquidity at the 145 wall. Once this institutional demand absorbs the final break-even sell orders, the overhead pressure on the price chart will clear. Crossing $1.45 on high volume removes the last significant block of overhead resistance. Once that supply is absorbed, the price moves into a low liquidity zone, allowing for rapid escalation toward the next target of $1.60. Beyond 160, the projection moves toward the 200-day exponential moving average. This sits at the critical psychological level of $2, which currently serves as the final barrier to a genuine trend reversal. A major regulatory tailwind is also approaching. The upcoming markup for the Clarity Act could drive the additional billions in ETF inflows needed to clear these higher price targets. Retail traders are using $1.45 as an exit to salvage losses. For institutions accumulating billions in volume, that same level represents the point where selling pressure finally yields to net inflow.